You pay closer to 25% of your income in taxes. In Canada, if your income is $70,000, you most likely pay between $16,000 and $17,000 in tax every year. As Canadian, we hardly passed a severe wave of inflation and the highest interest rate. Stay tuned till the end, and I will tell you how you can keep more money in your pocket rather than pay it in tax. There was a significant tax changes in 2024. Let's take a quick look at them to see how can we prepare and save money on taxes. Also, there will be new contribution caps for RRSPs and TFSAs and recently announced FHSA, which means First Home Saving Account, beside the changes in CPP. Hello, my name is Hani Adam, CEO of Pyramide Investment, official member of Forbes Financial Council. In this video, we will discuss some tax-related news that was recently released by the government, as well as new RRSPs and TFSA contribution caps, and the recently released FHSA program, beside the new pension enhancement and CPP, and the tax bracket change in the new budget. Let's explore the significant adjustment that Canadian government implemented beginning of 2024. The federal government's plans to deny income tax deduction for expenses incurred to earn short-term rental income, including interest expense in province and municipalities or short-term rental restriction are in place. The federal government will deny all expenses happened on or after January 1st, 2024. Another change, those who see physiotherapist, chiropractor, or any counseling therapist now should expect to see reduction into their bills. The federal government announced that it will be removing GST and HST from those professional services to help ensure that Canadians could afford the care they need. If you are in Ontario and you pay 13% HST in each and every visit you do to your chiropractor, this stuff has been gone. If your bill is $200, now you save $26. Moving to the new contribution caps. Tax-free saving account, which is TFSA, originally introduced in 2009. The TFSA is a flexible tax-sheltered investment that can apply to any saving plan you may have. The wonderful thing about the TFSA is that you can withdraw from them at any time without incurring any penalties. Normally, if you invest in taxable account, you are liable for tax, to tax on your withdrawals. Also, if you save your fund or you invest it into vehicles such as like in a GIC or mutual funds, so your earning every year is taxable. So the compounding tax saving on your investment into your TFSA can be a significant over time. The only drawback is that withdrawal will be added back to your TFSA room for the following year. So your contribution room, which increase annually due to the TFSA annual room restrictions, determine how much you can contribute to your TFSA. Speak to your tax expert about this one in particular, because lots of mistakes happen when people try to save into TFSAs. Make sure you understand the contribution cap. The reason being is exceeding it might result in some fairly steep fine. The 2024 TFSA yearly room was raised $500 from $6,500 to $7,000, which is an adjustment to inflation. $95,000 is your 2009 TFSA contribution maximum if you were born in 1991 or earlier, which implies that you were 19 or older in 2009. Your TFSA contribution limit accumulate over time, and any unused room is carried forward so it doesn't just disappear. So let's talk about RRSP, which is Registered Retirement Saving Plan. The RRSP is a Canadian registered account designed to help you save money for retirement. When you invest in an RRSPs, you can receive income on tax deferred basis, such as interest, dividend, and capital gains. This means while income growth tax-free in your RRSPs, you will eventually pay taxes on when you take it out. Ideally, because that's when you retire, because your income would be less. The maximum allowable RRSP amount when you retire in 2024 will be 31,500, which with annual inflation, if you don't make any contribution to your RRSP or have not yet reached your maximum RRSP rooms, your RRSP limit will carry forward and accumulate, allowing you to contribute years and years after. Now, the new initiative the government came up with, which is First Home Saving Account, which is FHSA. This First Home Saving Account is saving for your first home. The federal government unveiled a new saving plan in 2023. Possibly the most intriguing aspect of the FHSA is that it combines the best features of the TFSA, which allows you tax-free withdrawal, and the RRSPs, which allow you to withdraw to finance your down payment for the first-time home buyer. The FHSA contribution limit is capped at $40,000 over lifetime and up to $80,000 in any given year. This means that you can max out your FHSA by contributing $8,000 each and every year over a 5 years period in order to accumulate $40,000 limit. Keep in mind that you can only withdraw funds from FHSA tax-free if they are used toward qualifying home purchase, first time only. If you open your FHSA account in 2023 but don't contribute, or you do not contribute the $8,000, you can carry that amount to 2024, okay, and contribute a total of $16,000 in 2024, because you can roll over unused contribution to use in the subsequent year. For the maximum of 5 years, total $40,000. The primary difference between Home Buyer Plan HBP and the FHSA is that FHSA allows you for withdrawal of $40,000 instead of $35,000 you can withdraw from your RRSPs. This implies that you can withdraw $5,000 more. That's not only that, which is free under FHSA, and that you are not obligated to repay the $40,000 that you have taken out, unlike the home buying plan, where it requires repayment of the withdrawn fund, which is $35,000 over 15 years period. So now $75,000 tax-free to easily get your first home when you combine FHSA and HBP. If you have a sufficient saving, you can also take advantage of both HBP and FHA, Home Buying Plan and First Home Saving Account. Allow you to make combined original contribution of $75,000 tax-free each toward your first home. So you 75 and your spouse 75. Now, Canada Pension Plan CPP, where Canadian retire, they begin receiving a Canada Pension Plan CPP, which pays out a monthly taxable benefit. So you have to pay tax on it. The maximum monthly amount, if you start your pension at age 65, is $1,364. But in October 2023, the average monthly amount paid for a new retirement pension plan or pension people at age of 65 was $758. Your circumstances will decide the maximum amount you will get upon retirement. Every person in Canada who is at least 18 years of age, works in Canada, and makes at least $3,500 annually is required to contribute for the CPP, Canada Pension Plan. So your employment income determines how much you can contribute. CPP is actually a deduction from your wages that you will receive back when you retire. The CPP contribution remains at 5.95% of your wages in 2024. the same as in 2023. However, the 5.95 applies to a new maximum annual pensionable earning, which is 68,500, up from 68,667 in actually. In fact, your employer also pay for your CPP. Your employer must match your annual pension earning, which are capped at 3,867 for employees, up from 3,754 last year, and increase, which is increase of, I believe it's about like $135 if I'm not mistaken. If you are a self-employed, you must pay both employee and employer contribution to the maximum of $773. In order to better understand the tax rate that would actually affect us, I would like to combine the federal and Ontario province rate. As you can see, the first 51,446 in 2024 are taxed at 5.05. It's the same tax rate as in 2023, but the increase the amount of taxable income for that particular year in 2024. So let's work as a combined rate. So as you can see here in 2023, the first 49,231 were taxable at 20, 0.05. Okay, right now it's same amount, same percentage of tax. However, it increases from 51 to 51,446. Okay, a good news too for the higher income. Okay, so before we talk about the higher income, let's talk about how the tax system works. So again, let's talk about the person we spoke about him earlier, which he's doing 70,000, or he making $70,000 each and every year. So he will pay 20% on, or 20.005% on his first 51,446. Okay, but anything from 51,446 up to 55,867, he will pay 24.15. He's not gonna pay 24.15 on all this amount. No, he will pay only on the difference between 51 and change to 55 and change. It's closer to $4,000, $300. Okay, anything from any earning above 55,867 all the way up to 90,599, he will pay 29.65%. Okay, what does that mean? For in our case, he will pay the difference between $70,000 minus 55,867. This amount he will pay 29, because the taxing system in Canada is very progressive and escalating according to the income of each and every year. Now, let's talk about the people who earn higher income. So the highest income here, anything over 246,752 are now taxed as 53.53. So the government kept, the same charge for income tax for that tax bracket. However, it increased the amount of the allowable tax here from 235,000 point, 235,675 into 246,752, which is almost extra $11,000 will be taxed at lower rate. Want to know exactly how this change can affect your income and can affect your retirement, and how choosing a good investment vehicle can help you lower your tax rate? If you can click the link below, you will get a free 30-minute consultation to give you a tailored step to save 20% taxes you used to pay. It's not a joke. Just all what you have to do is just click the link below. Don't forget to subscribe to our YouTube channel to get fresh updates about the Canadian financial market that impact your daily life and your future as well. Thank you so much.